So thank you all for coming. And I have met many of you already. And as you know, I'm visiting Yale this spring semester. So I have worked a lot on blockchains. So when I was thinking about the seminar, I was thinking about, okay, what should I present? I have so many things I can talk about. So, and then I come to this idea that probably most of you, because you're in CS, right? You are not necessarily familiar with people who work on blockchain from the business school. So I would like to give you a quick overview of some of my work in this space. So just to give you a taste about how people from business schools approach blockchain problems. And I think, so that's why I'm kind of going to be combining a couple of papers. I think it's easy to do here because I can skip a lot of background because most people already know what's going on. And then by the second half, I would like to just talk a little bit about some attempts. I'm trying to bake cryptography into game theory. Of course, talking about cryptography, I'm really no expert. I'm a student to everyone here, but I think it may be just more productive to tell you something that I'm thinking about recently, so that maybe we can see if there's any synergies. All right. So yeah, as I said, the plan is that. Okay, so just the one slide, a quick overview of some of the work I've done, and then I'm going to zoom into specific papers. A lot of the work I've done is in game theory and mechanism design and applied to blockchains. So here's a bunch of papers. So the first two papers that I'm going to be talking about, one is about the industrial organization of mining, and another is about the implications for carbon emission. And so I mean, just by coincidence, it seems to be both papers actually about Bitcoin. I've also worked on some other papers. So one is about crypto tokens and what is the value for crypto tokens for platforms. That was recently published. We worked on this paper actually 7 years ago, but just in our field, it just takes forever to publish a paper. So it was recently accepted. And then I have another paper that is trying to take the Byzantine fault tolerance protocols and ask it, what if that there's not just honest players, honest nodes and Byzantine nodes, but what if there are rational nodes and Byzantine nodes? What is going to be the equilibrium looking like? How do we even do that? So that paper is currently R&R at Management Science. So probably will take probably another couple of years. And then finally, I have another paper. I probably will briefly mention that I have some issues with the optimistic solutions, especially optimistic solutions for scaling. And I think they are not necessarily incentive compatible. And I may briefly mention that in the second half of the talk. Okay, so this is a quick overview. Certainly, this is not giving you a detail about it, but just this is really just some points that if any of them connects with you, I will be happy to talk more about after the seminar. And then just very quickly, I have a bunch of empirical analysis of blockchains, and I think I'm going to skip most of them because I'm going to want to focus on game theory. And I also have a bunch of other papers that is using game theory that is applied to other topics, not necessarily blockchain. Some of them potentially has implications for DAOs or for DeFi, but I'm not going to talk about them. Okay, so what I'm going to zoom in now, just for the sake of time, I'm going to talk about, so the reason I choose these two papers is because the first paper is probably my most cited paper. So I think, and also I personally think it asks a very fundamental question in blockchain, is that whether decentralization is sustainable or not, right? So I would like to introduce this paper. And the second one is one of my latest work. And the motivation for that is I'm really trying to think about what greater good that the blockchain technology can bring to the outside world, even if this outside world don't care about blockchain at all. Because I think for us as a field, right, for us to attract more attention, to get more grants money, all that type of stuff, we need to convince people outside of blockchain that what we're doing is actually very useful. And you'll see that some of my in the second half, what I'm trying to do is also going to try to fit this theme of trying to understand what we learned from blockchain, how can it be applied more generally to fields outside of blockchain. All right. So any questions so far before I jump into the first paper? Okay, so the first paper, this is actually a paper, this is a paper that we published in 2021, although we started it in 2018. And no, we finished it in 2018. And the motivation for that paper was really just like, this is actually a graph that we plot ourselves. So remember, that was like, we started in 2017. So at the time, really the focus was on blockchain, was on Bitcoin. Right, so we were actually just looking at Bitcoin mining pools. You're probably all very familiar with those pie charts about the pool distributions, but we just kind of take a very different perspective. We kind of like look at over time, how does the decomposition of Bitcoin mining pools, how does their share evolve? And so we see that at the early history, there's basically no pool mining, but over time, the entire share of hash rate is being gradually all attracted to different mining pools. For now, here, each different color block represent a different mining pool. And then what we observe over time is that first, more mining actually happens within pools. And often that mining pools, they grow large and they grow small, but does not over time seem to be a one particular mining pool that is dominating the entire the entire industry. Okay, so when we look at this, right, our very natural question is, okay, well, first of all, what are the forces that attract everyone into mining pools? That's probably something that everybody knows about, is about like smoothing income, right? But if there is a benefit from smoothing income from joining a mining pool, wouldn't just there be a force that just like basically attract everybody into a mining pool, or just like one mining pool become even larger? Okay, so if that happens, that basically defeats the purpose of decentralization in the first place. So we want to ask, what are the forces that shape the centralization and decentralization? Right. So this is one fact that we try to address in that paper. And then also over time, we see here, if you notice that we also have this red curve. This is just the logarithed version of the hash rate, and we know it has been growing up. A lot of them comes from just the increasing technology, right? Each gets better. But we also have a question about whether this rise of hash rate has anything to do with the rise of mining pools, right? So we are going to set up a game theoretical analysis and to address all these questions I'm posing here. And then we also will provide some empirical evidence to support our game theoretical analysis. Yes.
Just how do you determine whether it's mining pool with the address on the Coinbase transaction? Or?
Yeah. So usually they actually mark it very explicit. Okay. So I'm not going to actually include much math as in the paper, but I think because I just like to illustrate the idea. And the first of all, like, why do you want to join mining pools? Well, because if you join a mining pool, your mining income is going to be smooth, right? So I think that's even by the time we started the paper, I think that's basically what everyone knows in the community. So there's nothing new to be talked about here. But then a natural question is that if the benefit from joining mining pools is from income smoothing, then like it's very natural to think about that. If you join a large mining pool, the benefit from this income smoothing is going to be larger, right? Because it's just like as if you're buying lottery. If you partner with 1 million people to buy the lottery together, there's very little risk involved, right? Because you know that this block probably is going to win. But if you just partner with your friend to buy a lottery, then still the chance of winning is still very small. So your income still is going to be very volatile. So that's, I think when we started the paper, that's kind of the idea, and also a lot of concern in the community is that because joining large mining pools will give you better risk sharing benefit, if a pool starts being large, new miners are more likely to join this large pool, and this large pool will grow ever larger. That kind of that's a centralization force, and that is going to defeat the entire purpose of decentralization, right? So that's a concern in the community, and we would say, oh, okay, if this actually is, how does that actually sustain the decentralization of mining, right? So, but in reality, of course, the problem is a little bit more nuanced. right? So because if you join a mining pool, it's not like you just like share the mining reward from the pool, right? The pool manager also takes a cut out of it, right? That's the pool fee, right? And we actually look at the data and we find empirically, right? A large mining pool tend to just take a larger fee, so that it takes a larger cut out of it, right? So now if you think about if you're a miner, previously it's very like if you just think very simply, oh, if I have to do a binary choice to join a large pool versus small pool, okay, I'll go to the large pool. But now the problem, it becomes a little more complicated if we know that the large pool takes a larger cut. Okay, I don't know. Okay, join this pool, there's better risk sharing benefit, but also there's a larger cut that is going to be taken, right? So now it becomes a little bit tricky problem. How should I choose? Right. So this is like probably is going to be a puzzle, like a difficult question for people not in finance. But the benefit of being in finance is that we're actually very familiar with these problems, right? If you think about what people in finance, I'm like people in finance do a lot of things, but it's like one very simple thing people in finance do is about portfolio choice. In portfolio choice, you have two stocks, right? One stock has one stock has lower risk, okay, but also lower return, right? Another stock has higher risk because because you're sharing with a smaller group of people, but it takes a smaller cut, so you have higher expected return, right? So people in finance deal with this a lot. How do you actually manage the trade-off between risk and return? Okay, and also one very important lesson in finance is that when you face multiple different stocks, what you should do, you should diversify, right? You should not, it should not be kind of trying to attribute into a wrong set of thinking about, oh, I have to choose between large or smaller pools, right? Actually, if you are think about like a finance person, right? When you have different stocks, you should actually form an optimal portfolio about these different assets. Translate into the Bitcoin setting, right? If you're a miner, especially if you're a large miner, you have a lot of mining machines, right? If you face these two pools, you should optimally allocate some of your hash rate to one pool and allocate some others to another pool. And that gives you a better diversification benefit. Why there's been diversification benefit? Because the event of this pool finding a block versus this pool finding a block, right? These are two random variables and they're independent random. Right. So if you can actually pull them together, you can enjoy better risk sharing benefit. I hope that's.
Aren't they mutual exclusion?
Well, depending on how you look at it, right? So like ex ante looking at it, like if you just ex ante, you don't know which pool is actually going to get the reward, right? So they're independent. Exposed, yes. Like if I win this block, of course, economics.
So can't a malicious miner just be with the big pool, get there, enjoy the risk there, but work with the small pool to get bigger rewards when they actually win. Like for example, so you said that they're going to split their hash rate.
Yeah.
So why not just be in both? And when somebody else wins in the big pool, so that's a low risk.
So when you say be in both, I think you were talking about I have a big hash rate.
Right, but how do you enforce that? I guess that's my question.
Oh, I will show that this is actually the optimal thing for the miners to do. It's not, you don't have to enforce it. If you are a rational miner, you care about the optimal risk and return trade-off from your mining decisions. This is what you should be doing. You should allocate them across different pools.
Narun, what you're asking is like, how do I know how much rewards the miner should get, right? Like miners get rewards based on their shares, like
Right.
Yeah.
Right.
Oh, you're talking about the mining pool operation. Like if I contribute to this pool, how do I get a fair share?
Right, but how do I mean, I guess my question is more like, so I am allocating hash rate. I don't think I know what that means entirely. Because I was assuming, okay, what if
just computing power? You think about computing power.
Okay, so if it is computing power and when I win, suppose the miner wins.
Okay.
Do both pools win?
No. So like for each block, if there are only two pools, one of the pool will win.
One of the pools.
Yeah.
And when the smaller pool, I as a miner
get
a better reward, right? If I won with the hash power.
Well, you tend to get a larger, for the same amount of hash rate you allocate to the large pool versus small pool, you'll get a smaller share, or you'll get a larger share within the smaller pool. But the smaller pool overall is less likely to win the block because it's overall.
But as a miner, I'm just independently doing this computation, right, on my own machine.
Yeah, no. You are like the detail is that you have you join one pool, the pool will send you, okay, you basically do the hash problem for this particular hash puzzle. Yeah.
Okay.
Yeah.
Okay.
Okay. Any other questions? Okay. So yeah, so the idea is that you should actually be diversifying across these two different pools. Okay. And this is actually turns out to be going to be very important. Of course, I haven't told you, right? How should you actually optimally diversify? But at least I hope the notion is straight that you should diversify across these two pools. Okay. So actually, so this is actually a little paper that aside from this project, my colleague Mesa Fatidi, and she had a graduate student. So we actually just like as a side product of this project, we actually wrote a little paper. We actually have a little. It's not a TLS, so but just so we have this like little website that actually has a numerical solution, right? So if you are a miner, you can actually just put in like which currencies, what mining pools. If you choose Bitcoin, the mining pools will optimally pop out. I don't know whether that website is still updated now, at least by the time it's updated. So it contains all the pools. You tell what is your hash rate, right? How much computing power do you have, and how risk averse you are. And just the back end of this website will just give you, like, it's almost like a robo-advisor will tell you how you should allocate to different mining pools. Okay, so that's that paper. So I think did I skip one slide? No, okay. Yes, so I think I'm missing one slide because on one slide I want to tell you about what is the optimal way for you to allocate hash rate. All right, so maybe let me just talk about around this one. So, so we can say, oh, we have a numerical solution that can tell you what's your optimal way of allocating it. But we also want to give you some more heuristic about how we should actually approach this problem. So the idea is going to be the following. Suppose two pools, if they charge the same fee, okay, right? In reality, of course, different pools, they charge different level of fees. But if the pools, they charge the same level of fees, then you should be allocating your hash rate in proportion to their size. Okay, so that is actually one theorem that we proved in our paper. I think someone is laughing. Does it make sense or it sounds weird or? Okay, so, and of course, in reality, different pools charge different fees. So that means that if this pool charge a higher fee, then you should basically be allocating your hash rate a little bit toward this pool. So like the benchmark is allocated in proportion. But if a pool charge a higher fee, then you tilt your hash rate allocation a little bit to the pool that charges smaller fees. Right, so that is basically the major insight that we can say. Right? The quantitative insight we have from our analysis. Okay. So that we can see that how does that? Okay, actually I have this here. No. Okay, so how does that actually help us to understand the dynamics of mining pool evolution, right? So just forget about the slide, right? So you think about that. If in a world every pool charged the same level of fees, then all new hash rate, new mining computing power when they come into this industry, they will allocate their hash rate in proportion to the initial size of the pools. So that means that the market share of different pools will sustain over time, right? Just they will keep not, just like if you start being a large pool, you start being large in the same proportion because everyone allocates hash rate in proportion to their initial size. However, in reality, right, if a large mining pool, they charge a slightly higher fee, that means that when new hash rate come in, they will allocate in proportionally a little bit more towards smaller pools. That actually becomes a mean reverting force for evolution because if your pools start being very large, you charge a slightly higher fees, and then like the new hash rate coming in, right, allocates in proportion less to you. so that your market share will actually shrink. And if you're small, your market share actually will. Yes. Percentage terms, yes. Yeah. So I mean, the higher fee is in percentage terms. That's something we observe in the data. And also we set up a game theory model, and we actually show that the fee for if you are starting as a large pool, it's optimal for you to charge a higher fee, right? You know that you're going to be losing market share, but because you have a larger pool, right, you have more incentive to charge a higher fee to extract from existing. Yes.
Yeah, my question was related to what you explained now, but I'm still sure.
Okay.
Doesn't it make sense if you know you have a higher chance of winning more times by having a larger pool to charge smaller fees? So you win, you know, like.
So from the pool manager's perspective, if I'm operating the pool, right, eventually what I care is how much I get from. So basically, is my cut times how much blocks that I found among all the miners, right? So so that if we do we set up the model to do the optimal calculations, it's going to be an actual equilibrium among all these mining pool managers. It will show up as the optimal fee is going to be high. So yeah, each pool will charge the optimal fee given others' fee. So that the game is really between all the pool managers. And for miners, we just assume that the one key assumption is that the miners they will allocate hash rate, right? So some of them will be active, so they allocate hash rate optimally given the fee and the size of those mining pools. And also, it's important that some of the miners, right, they do not constantly adjust their pool allocations, because you can think about like not everyone is paying attention 24/7. Right? So based on that, then we can actually find that it's optimal for large pools to charge higher fees, and they just grow slower. So that becomes a centralization force. Yes.
And if you didn't have any passive miner, that's still go?
No, because the reason is because if you have if every one is super active, then your current size doesn't tell anything, right? Because like if everyone is constantly watching, okay, even if you're very large, everyone can just migrate overnight, right? So that your current size becomes irrelevant. So it's important that like there's friction. The people do not always reallocate all the time. So if you're being large today, you tend to be large tomorrow.
And is there just one?
I think so. Well, actually, I don't think we have we attempt a uniqueness proof, but if we look at a symmetric equilibrium, then that's the equilibrium. Okay. Any other questions? All good or? Yeah. Okay. So this is one side of the story. So another side of the story, which is something I'm also going to relate to the second paper I'm going to be talking about, is that this is not just about pools, right? So this is about how does the rise of mining pools actually change miners' incentives? Okay. So suppose you're just a miner. So if there's no mining pools, then you know that mining is very risky because you can just mine for 1 year and don't get any block reward, right? That is going to affect how much resources you commit, example, right? How much equipment do you buy? If you think about, okay, mining is quite risky, then I maybe the optimal scale for my mining operation may just to keep it relatively small, right? But now think about if there is a pool that is in existence. Now I can join pools so my income is more smooth, right? If my income is more smooth for the same level as risk-bearing capacity, I should feel that I'm actually confident to actually allocate more resources into mining. Right? Just think about like if you all your savings, right? I'm saying that now I force you all your savings to put into stocks, right? And or you do not invest, and then you think about, oh well, okay, stock is quite risky. I'm probably not going to allocate all my wealth. I'm going to pick a small percentage of it. But now say like, okay, now you can so suppose that this is about the money market funds, then you can say, well, actually, okay, I'm willing to put a lot of my wealth into money market funds because the risk is a bit smaller. Right? So the same effect goes on, is that if the rise of mining pools, right, actually gives miners insurance. And we know that when there's insurance, people can tend to be, this is called moral hazard. People tend to behave more recklessly because you're not shouldering all the risk. Right? So that goes, what the implication of this is miners are willing to commit more resources into mining. And if everyone thinks in that way, that means that the total hash rate and total computing power devoted into mining is actually going to be higher, right? So that's why actually we did some calculation in the paper that like compare the case when there's no mining pools versus the case in which mining is actually completely dominated by mining pools. The total hash rate committed into mining it tend to increase by 10%. No, sorry, 10 times. Okay, so it's 10 times. You can say, well, whether that's a dominating force, most of the hash rate increase is coming from technology, right? But I think 10 times is still a big number. But anyway, so I'm kind of like, I'm skipping a lot of math, but hopefully I'm giving the kind of all the intuition is that if we consider, if we model the competition between these different mining pools in terms of their fee settings, then we'll find that large pools charge higher fees. That will actually become a force that let the larger pools to grow slower. So that is a decentralization force to sustain that we have many mining pools and don't have a single pool just grow larger. And any questions on that? Yeah, so I think the takeaway from this is that I think the centralization versus decentralization is a very fundamental question in blockchain, right? Because the decentralization, the selling point in blockchain. So I think it's very important for us to understand whether decentralization can necessarily be sustained. If you ask a random economist who does not work in blockchain and you tell them the idea about decentralization, they will think about it as like perfect competition. But in economics, perfect competition is usually very, very rare. It's just not very easy to sustain. So that, in other words, it means that just like decentralization is actually like whether decentralization can be sustained in the long run is something that is worth thinking about from an economic perspective, right? So I mean, the study was in the context of mining, but I think I'm still constantly interested in any of the centralization versus decentralization forces in some other settings. So it's not some of, for example, we observe in maybe supply chains. All right, so this is the first paper, and hopefully I'm giving enough detail, but also high level enough so that we can have time to talk about other stuff. Yes.
Does it also consider like people exiting after the pool?
Not really. But the exit, but I don't think it's going to affect the results that much. Because like if you have your current allocation, right? And if you exit, right, just your alone is not going to change the market share, right? Because you're going to, if you proportionally just like take out all your hash rate across all pools.
Yeah, but I guess by exit I meant like maybe switch.
Oh, switch we do a lot. So that's what we mean by active hash rate. So active hash rate. So that was actually also to Aviv's question earlier is that if everyone is super active, that means that you're switching all the time, right? So then just like your current size doesn't matter. Yeah, the switching does play a role here. Actually, it play a key role here. Okay. So, I mean, this was a study done many years ago. And but this, like the fact that these mining pools leads to more computing power, right, more hash rate devoted into mining, so that, and also a lot of discussion about mining consumes a lot of electricity, and that's probably bad for the environment. That just sticks around, right? So like whenever you talk to someone, I because being in business, well, I have to sometimes talk to people who do not work in blockchain, and they have a lot of criticism about Bitcoin, or like that proof of work, consumes a lot of electricity. So so that's why I want to talk about something that I recently been oh yes.
Just before we move on, I just wanted to, I think I missed like, can you explain again how you got to like this final conclusion that the mining power, the mining pools increase the hash rate, like one more time?
Yeah. So think about this. So like, if you're just operating by yourself, it means that you think about mining is like, so first of all, like if you join mining pools versus not join the mining pool, the expected return other than fees is going to be the same. So the benefit of joining a pool is really just like to kind of reduce the risk that you face. Okay, so so if you don't join a mining pool, it means that mining is very risky for you. If it's risky, you are not willing to do too much of it. But if you see a mining pool, it basically provides insurance for you. You say, come on, I'm protected, so I can be reckless. Okay, let me double my operation. So if everyone thinks it like that, right? So the total hash rate devotion is going to become.
Question about
Hmm.
that. How do you model the miner initially when he needs to allocate resources? Is it with some computing power or something, right?
Yeah, so you have some computing power, and your decision is like also you have how risk averse you are, and then your decision is about, okay, I'm going to basically allocate them across these pools, and based on the fees and the size, I decide on how much to allocate.
And when you allocate, is it still a probability how much would be activated, let's say? And then if you're in a larger mining pool, you're willing to activate more or not? Like,
What do you mean
otherwise,
activate?
what does it mean to increase the computational
Oh,
power?
the increase the computation, yeah. That was the first part, is that I take how much computing power I have as given, okay? But then the second part is that I now think about how much computing power I actually invest in the first place. So that's kind of I should be more clear. This is second stage. It's like take a step from the previous step. Okay, all right. So yeah, so the second one is like people say, okay, yeah, okay, like Bitcoin mining consumes a lot of electricity, and so that's probably bad for the environment, leads to carbon emission. There's a paper on Nature and trying to say that Bitcoin mining is going to push up the global warming by 2 degrees. I have a lot of doubt about that paper. But anyway, there's also I met one scholar in China who's very proudly telling me that he has papers that led to the Chinese ban on Bitcoin mining, okay, because of environmental concerns, right? So the question is, well, yeah, there's no doubt that mining consumes a lot of electricity, but does it necessarily mean that it has more carbon emissions, right? So I think I want to answer this question, is like we need to think about, okay, where does the electricity for mining is actually coming, right? If it is coming from like renewable energies, then it does not necessarily mean that the carbon emission is going to be higher. And actually, so this is some recent things I've been working on, is I'm actually show that, well, with the right electricity price policies, actually Bitcoin mining can incentivize more investment into renewable energies. And overall, it actually can lower total carbon emission in the entire economy. Okay, and I'm going to explain to you why this is the case. So if we look at renewable energies, right, it has 2 benefits and 2 disadvantages. 2 advantages that, like, first is that, well, the carbon emission is, we can basically assume it's 0. Okay, it's very low. Okay, and also once you have the capacity of renewable energy in place, the cost of generating electricity from renewables is actually very low, right? If you think about the wind turbine just running, okay, versus like burning coals, right? So these are the advantages. The disadvantages is that, well, first of all, if you want to build capacity for renewables, the fixed cost is very high. You need to build turbine or build a dam, right? So the fixed cost is high. And second is that the supply for renewables is very volatile. Think about wind turbine; it only runs when there's wind. Okay, solar, it only runs when there's sun. Okay, so the supply from renewable energy, right? It's very volatile. It does not come synced with the demand for electricity. Okay, and we know that there are some technologies for electricity storage, but they're still very limited, so kind of negligible. Okay, so that means that we cannot solely rely on renewable energies, because if we want to always constantly, so electricity has this property, right? Like, other than very limited electricity storage, like it has to be consumed in real time when it's produced, right? So if there's the supply and the demand is not fully synced, that means that we need to have some extra shock absorber. And traditionally, the shock absorber will be like fuel energy, right? Because you can burn more fuels or burn less fuels in real time, right? To adjust how much, to basically balance the demand and supply. But now but that's not good because the fuel energy releases carbon emissions. But what if we think about Bitcoin mining? What are some advantages? What are some unique attributes of Bitcoin mining? First of all, I mean, it consumes a large amount of electricity, right? So second is that because proof of work is memoryless, right? You can very easily quickly turn on and off a mining machine without really interrupting its business. So that means that we can actually, instead of from the supply side, we use full energy as a shock absorber. We can potentially use Bitcoin mining, right, by adjusting how intensive mining runs in real time. So basically, in the demand side, we can use that as a shock absorber. Right. So if we use that shock absorber, the net outcome would be that it will actually now we incentivize more renewable energy capacity building and will lower total carbon emission. Yes.
Quick question. So you only consider electricity consumption, but there is also the manufacturing emission to build the ASICs and so on, and those devices are removed regularly. Is there like data showing that the emission from manufacturing the devices are relatively small?
That is not something I have considered, and I don't know. And I think to the extent that ASICs, because they are ASICs, it's probably very difficult to recycle. So I think that is going to be a force that counteracts what I'm trying to argue. I'm only looking at electricity from this moment. Yes. Okay. So that like economists, what they do is like we look at a problem and we simplify it, right? So I'm kind of going to coming up with a very simple model. The simple model has two sides. There's demand side and supply side, and the demand and that market is for electricity. Okay, the demand is there are two sources of demand. One is I call it regular electricity demand. You just think about households, industries, whatever, right? So they have some exogenous and random electricity demand. Okay, just like it will be captured by some random variable, period. And then also there's electricity demand from Bitcoin miners and their profit maximizing, right? So like to the extent of Bitcoin mining will go to what extent Bitcoin mining will go on will of course depend on a lot of things like the block reward, right? Bitcoin prices, and also electricity prices. Okay, and then the interesting aspect all happen on the supply side. So the supply side has two players. One is called the regulator. You can think about the regulator is like in a utility market in the US, right? A lot of them are highly regulated. So a regulator is basically in our model just specify electricity price policies, right? It may set different electricity prices to regular or miners. The reason why this is doable is because of, like, at least in the US, a lot of mining is done at large mining farms in upstate New York or in Texas, right? They're usually in very remote areas. So it's kind of easy to monitor their usage and to set different prices for them. And also electricity price may depend on supply demand conditions. In the US, this is called demand response program. Usually it's like, okay, when demand is very high, then we will try to charge higher electricity prices. Okay. So, and there's also a power grid. The power grid will decide how much renewable capacity to build, taking as given the policies set up by the regulator. Okay. And it fulfills all regular electricity demand. And then, so that's basically the supply side and the demand side. Okay, so we're going to analyze. So this side, the demand side, there's nothing really interesting. Well, the miners, they do decide on how much mining they want to do, but we'll show that it's actually something very simple. So the interesting tension will come from the supply side. Okay, so we basically will be asking, okay, if you are the regulator and you care about the controlling the total emission, okay, how much, what is going to be the optimal price that you want to set, okay? And then, like, given the pricing policy set by the regulator, the power grid is going to decide on how much renewable capacity to build. And then we're going to analyze overall, right, whether introducing mining versus not, right, actually it has the capability to lower total carbon emission. Okay. So the grids problem, okay, so now we have this kind of formidable formula, but I hope I'll go one by one, explain what these are. Okay, so if you are the power grid, you want to choose how much renewable capacity K, you can think about it as a capital, right? How much capital you invest in the first place, right? To maximize your total profit. What is going to be your total profit? Well, there's two revenue sources. One is the revenue that you get from basically the electricity price you charge to regular users, households, other industries, manufacturers, right? And also the price, the electricity price, the revenue you collect from Bitcoin miners. And then the cost for you is one is the fuel energy that you need to burn. Right? I just assume that electricity, renewables is free, right? It's the variable cost for running wind turbine is zero. That's the kind of approximation, right? But just like to capture the fact that it's much lower than burning fuels. Okay, when do you need to burn fuels? When the demand from electricity demand exceeds the electricity supply from renewables. So that's why I have a positive sign here, right? If this only when this term is positive, would you incur the cost of burning fuels, right? So this is one cost. And also like you have some initial cost of building renewable capacity. Right? So that is basically the idea of the grids problem. Right? So you can think about and then the demand for Bitcoin mining, that is going to be a function of the price that is set by the regulator. Okay, and so what we will get coming out of this is that we will try to solve this problem, and then we'll see how does that actually can have impact on the carbon emission. Any questions? So good. I mean, this is a long formula, so hopefully intuitive. Okay, so now what is the grids problem? Right, the regulator's problem. Okay, I mean, this is of course being a very, very simplistic model. Okay, so we just assume that the only thing that regulator cares about is to reduce total emission, and the total emission is basically the extra demand. Right, so that's okay. So now we think about that. Okay, the electricity, the regulator sets up the price to minimize this term, subject to the problem that we know that the K is going to be chosen by the grid. Okay. So now so this is actually a very classic principal agent problem in economics. If you know about the term, okay. So, but we can actually further simplify this term. First of all, we don't need to think about this term because this term is completely independent of any decision verb. Right? So if I remove this, it's not going to change the optimization problem at all. I'm also going to argue that this term is also independent. One way to think about this is that this is the revenue, right? The grid collects from Bitcoin miners. Why this term is independent of the grid's decision? Well, in one extreme, if we believe that Bitcoin mining is perfectly competitive, that means it's fully decentralized. Of course, we know that it's not true, but just think about it as an approximation. If approximately we believe that Bitcoin mining is perfectly competitive, that means that like the competition is so fierce, right? They earn zero profit, right? Because if there's any more profit, there's going to be more intensive competition. So if the miners do not earn any profit, that means their revenue equals their cost. Right? And their cost is basically the electricity price that they pay to the grid. And the revenue they get is basically like what is the block reward times the block Bitcoin price. And these are also kind of independent of the miners' decisions. So we can almost think about this is completely independent of the grid's decisions. So if we take out these two terms, then we only have these two terms left. Okay, so this is just so we say basically we can convert the grid profit maximization problem into a dual problem of cost profit maximization problem into dual problem of cost minimization. So if we now look at this again, we see okay, this is what the regulator wants to achieve, and this is like subject to the constraint that this is what's going to be done by the power grid. And if you look at compare these two equations, then I think hopefully everything looks more clear. Because if we don't have this term here, these two objectives just align with each other perfectly. So there's no basically so-called no agency frictions. Why there's an agency friction is because, well, you know, the grid need to internalize the cost of building renewables, right? But the regulator does not internalize. So that's like making a difference between their objectives, and that's why like things cannot be perfect. This is just basically a very common theme in all kind of principal agent problems. So what is the key intuition? I think I'm kind of running a bit out of time. So yes.
So are you also making some simplifying assumption that there is one, or this grid is for all miners?
Yes, yeah, that's there's one. This is a great, a very big simplification that we're making. We have an extension that we're working on is to have multiple grid. Of course, the math is no longer going to be that beautiful. However, if we can, in those cases, the usual trick is to take some limiting case. For example, if like the number of miners is really large compared to the number of grids, and then we can have some like limiting results, which again is more nice looking. We don't have in the slides yet, but we're working on that part. Yes.
And miners can move around also, yeah. Like they can leave.
Yes, certainly.
Which would affect the first factor. Because the revenue from miners would depend on when they leave or when they join.
Well, it depends on whether there is like policy coordination among different regulators, right? If there's a very good coordination, then it's like if they are all following the optimal policy, then it doesn't make sense. Like it doesn't make much difference, right? You can go whichever way. Right. But if there are differences, then yeah, that will be interesting questions. So actually one thing that I've been interested in doing, but I just never got a chance to do is like for example, like US and like some other countries that are very environmentally aware, right? They have policies that, for example, restrict mining. Then mining just go to other countries that actually is less restrictive on mining, and also probably the cost for mining is also higher. So I think overall, like probably the global impact is probably going to be worse, right? So but I mean for that, the economic argument is very simple. So it really depends on whether you can collect good data to have a very solid empirical analysis, which is not something I do a lot on. So I have this idea, so but I never work on that. But I think your kind of question kind of relates to that thought. Yeah. Okay, so so what is the key intuition, right? So we know that, okay, what is making things a bit complicated is because like the objective of the regulator and the objective of the grid is not perfectly aligned. So if we just think for a moment, right, if there's no such a term, what is going to be optimal outcome? That's like in what we usually call first best outcome, right? And now with frictions, we say what is the second best outcome? So let's just think about what is the first best outcome. If the first best outcome would be, if we just think about this term, right? So the first best outcome would be, suppose that there is some maximum level of the electricity demand, and there's a minimum level of, did I explain this as this is also a random variable, because if you build K capacity, it's not always going to be turned on. If like there's no wind, then this term becomes zero, right? But suppose that there is this term, the minimum term is not zero, it's like some positive number. Then if we just think about this term is that you just build, if the policymaker, if the regulator can unilaterally decide on how much renewable energy capacity to build, the optimal thing for them to do is to build a lot of renewable capacity so that whatever realization of demand is, I'm always going to be able to supply them. And then whatever, if there's going to be some surplus, I just give it to Bitcoin miners. In that case, what we see is that there's going to be zero emission, right? Because everything is supplied by renewables. But of course, this is because we do not internalize the cost of building this renewable. Right? So then, like, in order to kind of achieve this first best outcome, considering that there's this friction, so we need to actually like the policy need to incentivize some more capacity building. what is the way that we can what is the trade-off that the grid is facing? The grid, if the grid build more renewables, the fixed cost is going to increase. However, if you build more grid, right? So the electricity, the price that you need to pay, you need to burn fuels, your variable cost of operation tend to decrease. Right? So that's why like we would like to actually like somehow make this part more costly in order for the grid to be able to willing to invest more. So that is basically, you can think about the benefit of bringing mining, right? Because like the demand goes up. It means that if you do not build enough capacity, well, you're just going to burn more fuel if you want to satisfy that. So that kind of changes the incentives. So this is a key intuition. So so this is one example that we say, oh, what is going to be this is what is going to be the price that you can charge. The price basically is going to induce the demand so that like if the capacity from renewables is large enough, you just like give all the surplus to the miners. But if like the demand is larger than the renewable supply, then you promise to still provide some electricity to miners. But this is going to be a positive number, but it's not going to go to extreme. Right? So we can actually figure out what is the optimal D, and we'll see this is a graph that we chart. If we change this level D, what is going to be the total emission? It will turn out that initially it will increase, right? Because just now there's more fuels being burned. But there's going to be a region in which it will actually drop down to compared to the initial value. This is because if I ask you to serve the electricity demand for miners when there's demand is actually higher than supply, then it's very painful to the grid because now I need to burn fuels. So that's what incentivizes them to actually build more renewable capacities. And when they do that, it actually lowers total emission. But of course, if this goes further up, then the emission will go up. So bottom line is that there is actually a way for us to design electricity price so that the total emission actually will go down. Okay. All right. So how much time do we have? We have 1 minute. Okay. All right. So yeah, actually, this is more exciting stuff I want to just talk about. But this is like less. These are some thinking that I'm really interested in. As I said, like you can see that from the previous project, right? So the reason why I'm interested in that is because I can now give a bigger reason to policymakers and people outside of blockchain to say, well, you know, this thing that we're working on is very useful. And also, I just like, and recently I've been spending a lot of time learning cryptography. And I'm thinking about like how cryptography actually can help mechanism design. So just a very quick overview. I hope probably many of you have heard about mechanism design, and if you haven't worked on this a lot, it may look a little bit intimidating at first. But really, what they're doing is like we want to maximize some objective subject to some constraint, right? There's like incentive compatibility constraint or whatever. Okay, so and the key like a key observation in this literature is that there's a lot of impossibility results. Or sometimes you just have to live with second best result, as I mentioned earlier, okay? Or sometimes if you want to have some possibility result, you need to require some very stringent assumptions, okay? So, so how can cryptography help? Well, intuitively, yes, right? If you look at Bitcoin, right? By introducing cryptography, it makes some objectives previous difficult, now it makes it possible. But how, right? So I think the way is that it works is that, well, just mathematically, if we think about, I want to maximize objective subject to some constraint, but it's difficult for me to do. How can I help? Well, the only thing I can help is to remove some of the constraints. So this is a very high level I can think about how cryptography can help. Of course, like we want to make it more concrete if time allows. And time is out. All right. So okay, let me think about one slide that I summarize what I want to say. Okay, maybe just I will stay here so that Yeah, but anyway, this is like something I've been thinking about a lot. I have a lot of thoughts on this. Unfortunately, we don't have time to talk about that. And but I'm happy to talk more about this. Really is like what cryptography can help and when it cannot help. Okay, thank you.